can this market snap out of that bizarre malaise where the reopening stocks keep roaring and everything else, especially tech and healthcare, gets left behind? After the day where the Dow declined 104 points, S&P dipped 0.32%, and the Nasdaq actually did a little bit better, edged down 0.11%, but it's still headed for its worst month since October. Let me tell you what needs to happen. I've got the solution, all right? And it's a little complex, but I'll give it to you. First, there is way too much speculation in this market. We're still seeing lots of money pouring into areas that are very hard to value. Just look at the crawl at the bottom. I mean, you see this right down here. I mean, see right below me, okay? Look at this. I'm not saying those companies are worthless, but the amount of volume that changes hands every day in that low dollar stock and that low dollar stock and that low dollar stock, that should make you, look at that one, should make you very nervous. It's a sign of excessive speculation. With inflation, these are the moral equivalent of penny stocks, for heaven's sake. Second, too much greed. Yeah, one look at the newly launched ARK Space Exploration ETF tells you everything you need to know about how managers can't resist creating new funds, even if there's no reason for them to exist. They love to create ETFs. They love to advertise ETFs. Now, look, sure, this fund has some quality companies that can pass as space plays. They've got Trimble, Kratos Defense, L3Harris. Though something like L3 is mainly a high defense contractor. We have them on. You got Lockheed Martin and Boeing, which do have some space exposure, even if it's not their main business. The thing is, this fund also includes Amazon, Alphabet, and Netflix, along with some Chinese e-commerce plays like JD.com, Alibaba, Tencent. Deere's in there, too. Yeah, Deere, the tractor company. It's ridiculous. But there aren't enough genuine space-related stocks to make a decent ETF, and the manager wants to collect that 0.75% expense ratio. Maybe, I have an idea. Don't launch a space ETF if you have to pad it out with Netflix and Deere. You know what? I was surprised that GameStop isn't in it, because GameStop is synonymous with rocket ships over at Wall Street Bets. YOLO. It's not just ARK. Look, at the ridiculous amount of risk the banks expose themselves to with this ARKX hedge fund, you know what that's about? That's about greed. The industry might have lost $10 billion here, and we know they were avoidable. Why? Because this fund did not ensnare everybody. J.P. Morgan considered working with them and passed. They exercised something I've been searching for this word all day because it's not really available anymore on Wall Street. Judgment. Something that is in very short supply. And they decided this fund wasn't worth the risk. They didn't trust ARKX. They didn't trust it. Everyone else chased those commissions, with Nomura and Credit Suisse getting hit particularly hard because they were so desperate to show that they're the go-to banks for hedge funds that need absurd amounts of leverage.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.